Hello all and welcome to today's webinar. My name's James Gerrish and thanks for joining Market Matters on this month's Pulse Check webinar. We're going to run through an overview of quarterly performance across a suite of Market Matters portfolios. We're going to introduce you to two new portfolios that we've got open for investment and some changes around the platform that we're using in terms of the portfolios we've got open for investment. I'm going to run through 8 stocks that we like here and now. There's a lot of obviously movements in markets over the last 3 months to start FY26. A lot of the stocks have done particularly well, but we're going to highlight 8 stocks across 4 of our portfolios that we think look really attractive here and now. So that's going to be at the end. It'll keep you on the line for the end. And then we're going to have some Q&A. So please hold all your questions for the end and we'll get to those and we'll answer those for you. So thanks again for having so many on the line today. We're going to be short, sharp. It'll last for about 45 minutes. I'll be joined by Shawn Hickman, who's our research lead here at Market Matters, to run you through today's presentation. So just before I do, a quick disclaimer on the screen there that any advice provided today is of a general nature only. And you should consult a financial professional before taking any information on board. Again, it's general information only. I'll bring Shawn in now just to say hi before I run you through our investment team.
Morning all.
There he is. So I'm the lead portfolio manager at Market Matters. So 20 years experience across markets, and I'm responsible for all the final portfolio decisions across a suite of Market Matters portfolios. I'm supported by a research team, which is headed up by Shawn Hickman, 30-odd years experience at some of the major firms, and now heading up the research function at Market Matters. Peter Winty and Peter White round out the investment team. They're part of the investment committee and oversee our investment operations at Market Matters. Just a quick run through of our investment process. We cover this on most webinars, just to highlight that we're a top-down meets bottom-up investor. So by that we mean we take into consideration the macro thematics that are playing out. We form views around the macroeconomic environment that we're operating in. That filters into our sectoral exposures, our preferences across sectors. Then we look at stock selection and really importantly, stock selection, but probably more importantly, I think in my view, is around portfolio construction. And we're going to unpack how this investment process actually feeds into some of the performance metrics that have been over the last quarter. Just standing back, it gives you a quick understanding of the 5 Market Matters portfolios that we've got open for investment now. These are the returns of the published portfolios on the website. They've been ranging from various timeframes. So the active growth portfolio has been going from 2016. We added the income portfolio in 17, the international equities portfolio in 19, and then a couple of the newer portfolios, the emerging companies portfolio and the core ETF portfolios, the newest portfolio overall. So just standing back and looking at the quarter so far, so first 3 months of FY26, all portfolios have been performing well. The active growth portfolio is up a bit over 6%, outperforming its benchmark. The active income portfolio has done particularly well. That's up 7.5%. That's got an RBA cash plus 4% benchmark. Obviously, it holds a combination of high-yielding large cap Australian equities along with fixed income exposures, hybrids and other income producing funds, etc. So it's a lower volatility, higher income sort of portfolio. And that's done particularly well. There's been a really strong bounce back in the emerging company space. We know in 2025, it was a pretty tough investment environment in the smaller company space. But pleased to say we're performing strongly in the first quarter of FY26. If I rewind the tape and think about the last 6 months, that portfolio is actually up about 35% over the past 6 months. So well and truly outperforming its benchmark. And then the international equities portfolio, which is going to be featured in today's presentation, it's had a really stellar 3 months. So it's up nearly 17% over the past 3 months. Which is about 10% above its benchmark over that time frame. And then the core ETF portfolio, which is a newer portfolio in the Market Matters stable. It's designed to be more of a diversified multi-asset ETF portfolio, low cost, diversified, less active than our other portfolios, but it does operate within we call it a dynamic asset allocation framework, where we will upweight and downweight particular asset classes depending on their relative attractiveness or otherwise. So that portfolio has done 5.3 over the course of the last 3 months. Just breaking down our investment process, firstly, and you can probably speak to this, Shawn. The macroeconomic environment we think is really important. So sometimes you've got a macro environment that's got tailwinds. Sometimes you've got a macro environment that has headwinds. And I'll just bring you in here, Shawn, to touch on these 3 main things that we look out for in terms of the macro environment, and just to give viewers a sense of where we are at in the cycle.
Thanks, James. Well, not obviously, but the outlook is, you've probably all heard the Goldilocks framework at the moment. It's very strong, it's very supportive of equities, and it's why equities are knocking on the door of all-time highs across the whole suite of markets around the world. Most major markets are at, making, or very close to their new highs. And that's because earnings are solid. May feel a bit scary to a lot of people when we get some of the noises out of the US, but earnings are solid. Inflation, it might be a bit sticky in places, but it's not taking control. If anything, it's still falling away in most countries. And we are in an easing cycle. So interest rates are being cut, maybe not as fast as we'd all like in Australia, but they're coming down, and they're certainly not going up. And that's all very, very supportive of equities. And it was interesting yesterday when the head of the RBA, Michelle Bullock, she actually said that some strength coming into the economy is a good thing. It might not necessarily be what people are looking for, because they're just really, really feeding on rate cuts, but it's good for the economy and it's going to be good for earnings. So it's all about that balance, that Goldilocks scenario. We've got a good framework. Earnings are solid. They are very polarized. I think the last reporting season, James, was incredibly polarized, but we can touch on that later. But overall, the backdrop for the global economy is very, very good. And of course, we've got the exciting AI thematic coming through. So rates are still going down, not as fast as many people hoped. And the structural backdrop is good at this stage of the game. And China is starting to pick up as well. And we've seen a really good kick in the materials sector in the last month. In the last 3 months, it's actually been outperforming for the first time in a long time. And that's obviously good and supportive of the ASX 200.
Yeah, I think the main point you raise there, it's a good economic macro backdrop, but it's not great, and I think that's really important from a central bank policy perspective. So we look at those things. We look at how growth is playing out. Employment is obviously a key component of that, and we are seeing some easing in the employment conditions, which is actually a positive in terms of monetary policy. The key around inflation, and Shawn spoke of it there, it's around inflationary trends. And there was this expectation that coming out of tariffs, we would see a escalation, a ramp back up in inflation, so tariff-led inflation. So while inflation is probably a little bit too high overall, we haven't seen that kick up in tariff-led inflation, which I think is important. And then just touching on earnings. So earnings in the last reporting season were good, so profits are growing overall, but they are being driven by a lot of cost cutting. So that can't last forever. So I think earnings, if I want to pull out one thing on the macro environment that we need to be really conscious of moving forward, it's the trajectory of earnings once corporates have cut the majority of fat out of their operations, which we've seen, and then of course debt. So governments on one side are carrying too much debt, but on the corporate side, balance sheets are actually in really good order. So we sort of package this all up and say, we give a reasonable tick to the macroeconomic backdrop, so we can sort of understand why equities are trading where they are from a macro point of view. That then feeds into how we think about markets from a sector point of view, what sectors we want to be in. And I think there's 3 main things that we want to highlight in today's presentation, just around resources. Shawn made mention of those. They've had a really strong run. We like that area of the market. We like technology, and then we like high-yielding industrials, if we're picking out 3 areas of the market that are our favoured sectors. So when we think about these 3 things, it means we then want to be skewing portfolios, not going all in these 3 sectors, but we just want to be skewing portfolios into this area of the market. In terms of copper and uranium, specifically on the resources side, we like resources when we look out over the next few years, they're going to have demand that will outstrip supply. So something like uranium is very inelastic in terms of the amount of new supply coming on stream. And then we can see heightened demand coming through from things like AI, energy transition, and all of those things that are well documented. So those areas that we like, copper has a similar thematic playing out, and we saw it last week where Freeport had a operational issue and took one of its mines offline, and we had a big spike in copper prices. So that to us just shows how, I guess, tight the market is. And then gold, Shawn, it's been we've written a lot about gold in recent times, and it's continued to plow on. Maybe you can touch on the gold thematic.
Yeah, I'd like to touch on copper as well. I think that it's just really important to stand back and say the copper market this year has been very volatile. President Trump's gone in there and he's had a little play around with it. Obviously, we've also had Freeport this week. But the bottom line is we're very, very bullish over the next 1, 2, 3 years. You've got, as James said, you've got global electrification gathering momentum, which is also helping uranium. And both these factors will push up the demand for copper when it is in relatively short supply. And that's why the likes of BHP have been trying to beef up their operations. It's where people want to be. It's where the big resource companies want to be. And pretty much if they're not on board now, it's going to be very hard or very, very expensive for them to go there, because we've seen stocks like the local stocks like Samphire basically doubled in price. It's making it very, very hard for them to go any further. So yeah, it looks fantastic in the bigger picture. It's run a long way. One can say the same thing about gold. Gold's even gone further than we thought it would be, or certainly further than I thought it would be. We've been very positive gold for the last few years. It's at the moment, it's just taken any positive it can, James. It was taking the positive from the interest rate scenario, easing scenario. That's softened a bit. It was before that, it was taking the positives from central bank buying. That's taken a backdrop, at least from the news point of view. And now it's taken any positive it can get. It's taken the positives out of maybe a US global shutdown. Government shutdown. The bottom line is the buyers are significantly outstripping the sellers. And all of a sudden, we're trading at, I just glanced over at my Bloomberg then, we're trading around 38.60, and that magical 4,000 US dollar barrier doesn't look silly anymore. So it's very hard not to be bullish gold. We're not as heavily long as we'd like to be across our portfolios. It's gone further than we thought, but it's certainly an area where if it comes back, we'll be looking to buy again.
Yeah, I think that's an important point. When trades get, the market's universally bullish on gold. We often talk about everyone being on the one side of the canoe, which can lead to mishaps, if you like. So to me, in the short term, it's probably run too hard, and I think investor positioning speaks to this universally bullish call. But over the medium term, we remain bullish, positive on gold equities, etc. Have had a really strong run. And of course, you've got to dig down into the stocks, and we've had, in 25, we had a number of gold companies have operational issues. The majority of those have ironed those out. So gold is going to be a place that will feature back in portfolios throughout 2026. Technology is all the rage, right? So obviously AI is the buzzword. And I think there's three things we think about when we're investing towards technology. We like platform businesses. So by platform businesses, we mean that those that have been developed over a long period of time have a rusted on user base that can then monetize that user base effectively into the future. And I think there's, we've got quite a few in the portfolio. We've got Xero as a platform business, which has been under a little bit of pressure after making a large acquisition, but we think that really stacks up here. WiseTech would be a platform business where they've got ingrained users in the logistics space. Again, they've made a large acquisition. They've had a few missteps from a managerial compliance point of view, but that's a business we think looks really good. And I'll put in stage of monetization here because I think that's really important. We like these businesses that are going into an inflection point in earnings. So there's a lot of front-loaded costs that go into a platform business. There's a lot of money spent to scale. And I'd highlight a couple of these stocks here with RPM, which is RUL, which is does software for the mining sector. It's actually just been taken over, it's under takeover offer from Caterpillar. but we can understand why they're really interested in this business because of the stage where it's really ramping up the monetization of its platform. Catapult would be another one that we've got in the emerging companies portfolio. We also own RPM in the emerging companies portfolio. So if we're thinking about technology, we're thinking about we like to skew towards platform businesses, and we like to skew towards that stage of monetization where they're going to get that hockey stick approach and really monetize their platform. And then, of course, AI. So there's a lot of different ways to play AI. I think to make it simple, there's a couple of things around. We're at the stage of picks and shovels at the moment. There's a lot of software that's going to benefit from AI. There's going to be large-scale old world operations, industries in Australia like banking that will benefit from AI. It's really hard to know where AI is going to land over the next 5 to 10 years. So if you think about it now, I think that the picks and shovels are probably still the right place to be investing. And one of those areas, for instance, I'd throw out Goodman Group, which is in our active growth portfolio. It is still trading on the same multiple that it was when it was just a industrial sheds business. Now it's building data centers. So from building large sheds for Amazon and the like to now building data centers, but we haven't seen that valuation uplift. So I think that's an area that we should be focusing on at this point in the AI cycle. And then we still like high yielding industrials who've got predictable earnings. You want growth, but not too much. We wrote about Dalrymple Bay Infrastructure this morning. We think that's a really interesting stock. And there's a bunch of these names across our income portfolio would be the best place to look for those. So we want growth and growth in earnings and growth in dividends, but we don't want much because the faster something grows, the more, a higher element of risk and less predictability comes into it. So we like those high yielding industrials as well, if we're picking out 3 sectors that we're particularly bullish on, Shawn.
No, absolutely. And the one thing I would add to that, some of the press are starting to talk about it's time to move on from the picks and shovels of AI. And I think one has to look through it to what comes next, of course. But last night, the video made all-time highs. These stocks are still moving. They're still doing deals. They're still putting together ways of scaling. And so I think, sure, we have to look through it. We have to look what comes next. As James said, we have to look who can monetize. That's a really, really important factor. But Goodman Group is one of my favorite stocks as well around these levels. One of the reasons we hold it, of course, is that these companies, some of them are being underpriced, some of them being overpriced. And that's where you've got to look through, see where the monetization, see where the risk reward is. We use that phrase a lot, I know, but that's important.
Yeah, we do. I think that you often get asked, so what will the landscape look like in 5 or 10 years' time? So who are going to be the winners in 5 and 10 years' time? So that implies, how is the market change? How is it going to evolve? And what company is going to take advantage of that evolution? I sit back and am probably thinking about it from the other side of the coin. So more about what will stay the same. So understanding how things are going to change is going to be a really hard ask. And it's going to be probably fraught with danger. I think one of the things in AI is around thinking about what won't change. So demand for data won't change. That's going to be a ongoing thematic moving forward. So the data centers and being able to clip the ticket like Goodman does at every stage of the sequence as they build out these facilities, I think is a really undervalued thing at the moment. I think I don't want to harp too much about Goodman, but I think it's a really good way to play the AI thematic moving forward. So that's in terms of our favoured sectors here. And then let's dig into how stocks have performed. So over the course of the last 3 months. So we've had the active growth portfolio, that the return over the last 3 months is there, and then our best performing positions, the same with the income, emerging, international and core ETF portfolios. The next slide will look at our worst performing position. So at Market Matters, it's really important to understand that we're putting the reality of what we're doing out there. These are real portfolios that that we invest in, a lot of members invest in, and I run wholesale mandates for clients as well, and we've got a large amount of money across these portfolios. So these are real, they're not fictitious, and we've had a wonderful advance in mineral resources over the last 3 months. But in FY25, that was a real drag on performance. Shawn, is there anything you want to pick out of these themes that you can see across these winners in portfolios in terms of stock selection?
Not specifically. I mean, obviously, we all can see the resources there. They are going to have the chapter. This chapter might last another 3-6 months. They'll get ahead of China. China starts to turn the corner, and we might see them actually plateau. A lot of the quality Australian tech companies are starting to go a bit quiet. They're starting to drift well and truly off their highs. And we might see them come good in the coming 3 to 6
So
months.
you're talking Seek, you're talking car sales, you're talking Zero, you're talking WiseTech in that realm.
Exactly, they're coming off they're coming off a period of euphoria, and I think we've just got to be flexible, as we saw in reporting season. This is a very polarized market. When you get one sector has an awful day, the market still seems to hold happily. It seems to love this 8,800 level, as we all know. It's almost there again today, because what the market is not moving as one. And at the moment, the resources are very strong. We feel they've got further to go, but at some point in time, we feel that the tech stocks can come back on. There's not really a tech stock on that page, and that's quite unusual over the last few years. Or SiteMinder, I take that back.
Yeah, but that was probably a more situational based earnings related rally in share price. I think the key takeaway for me is around how these portfolios, the composition of these portfolios play out. So obviously active growth is more probably a high beta portfolio skewed. It's more heavily skewed in resources, and that's benefited that portfolio over the course of the 3 months. The active income portfolio is a real diverse portfolio. So we've had three companies in three different sectors that have added to performance over the course of the 3 months. Helia was an opportunistic play that we took on after they lost the ING mortgage insurance contract. That, of course, came on the back of CBA losing, Helia losing CBA's business as well. But there's some offsets that the market absolutely crucified this share at that time, and we went in and bought that into weakness, and that's suddenly up 40-odd%. So that's a high yielding financial stock that we can see is going to have a lot of free capital available on its balance sheet to support distributions and buybacks and the like moving forward. Centuria was a stock in our income portfolio that's been a bit of a struggle over the last couple of years, to be honest. But suddenly, at their results, they really guided to an improvement in the underlying trends across property at a high level, but within their business. They've gone from being in preservation mode to now being in growth mode. So we still like Centuria, even despite the run. And then Fortescue, obviously, just on the back of iron ore prices. The emerging companies portfolio is more stock specific. SiteMinder, although it's up 60-odd% over the course of 3 months, we really still like that stock, and we think it's going to continue to do well, and we're going to likely hold that stock moving forward. RPM, as I said, is under a bid from Caterpillar. We've got Catapult in the emerging companies portfolio, and that continues to do well. The international equities portfolio that we'll feature here today has had a phenomenal 3 months. There was one position that did particularly well, iron, up 161%, but it was actually only a 2.5% weighting in the portfolio. So it hasn't been the main driver of portfolio returns over that period. We have actually sold iron out of that portfolio now, so we don't own it anymore. Phenomenal performer over a short period of time. And a couple of the ones that you probably wouldn't expect. So Peabody is a coal company. We wrote about it last week and probably set out there. So it's trading in the mid-20s at the moment, setting out a pathway that it could trade above $40. So that's one we still particularly like. And then in terms of the ETF portfolio, gold has obviously been the major driver of returns there. Probably let's get on to the worst stocks over the period. And I think this is, so if you think about our investment process, it's about looking at the macro environment top down. It's looking at sectors. It's looking at stocks to invest in, so picking the right stocks. But then it's about portfolio construction. And portfolio construction is really important because not all stocks go the way you expect them to. There's a lot of variabilities in the market that can knock stocks, and having the right position size and how each company fits in the portfolio relative to others is really important, because you're going to have these periods. You can still produce good returns by having companies that surprise you negatively, Shawn.
unfortunately, it's almost inevitable, as you say, James. You have a portfolio, 20, 30 stocks, whatever the number is, they're not all going to go well. And hopefully they don't all go badly. But in this particular case, we had a very, very volatile reporting season. I think we wrote a few times, one of the most volatile I've ever seen, and I'm the older statesman in the team. And those three stocks in the active growth portfolio, they all got not so much Wise Tech, but James Hardy in particular and CSL, they all got clobbered after they reported. It's been a long, long time since CSL, if ever, has been clobbered after it reported. It went into the result with high expectations. It rallied into the result, which is always something that should be taken into consideration. James Hardy missed again. At the moment, it's lost the confidence of the market. The board has. Their huge acquisition is obviously weighing on sentiment as well. And so you've got to you've got to make a decision when these things happen. Have we made a mistake? Do we get out? Do we average, or do we think the stock is now suddenly, because they tend to gap, don't they, James? They tend to go from A to B. They don't go there slowly. So you have to make a decision at point B. There's no journey along the way after a report.
One of the things I've noticed in the markets over the last couple of years is stocks run in the days following their results longer than they did historically, and that can be driven by a lot more algorithmic trading, so computers doing the trading in recent years, momentum investing, so a lot more quantitative based strategies that rely on earnings, momentum, etc., and continue to push stocks further. So I think that has the lesson for me is around stocks pushing up more than perhaps anyone expected, more than valuations would generally suggest they should, and also stocks pushing down. So one key, I guess, takeaway from FY25 for us was perhaps being quicker, not selling strength as early. So letting that, if a company has really a strong beat on earnings, there's more to play out there, and vice versa on the downside. So although stocks do gap down, Shawn, it can often be the right way to rip the band-aid off sooner rather than later. And I think there's a couple of ones, because we're talking about the international equities portfolio here. The trade desk is down 29% over the 3 months, and this has been a stock that we've held for quite a while, since 2020 in the portfolio. So it's been quite a long duration holding. It's been hugely volatile, and it's one now we've got on close watch. I think it's probably found the low at the moment. We're still up on our position, but not as much as we were. And that's one that I'd be a little bit reticent at the moment to having big weightings in. So we got a smaller weighting in the trade desk, but we continue to like it. Chipotle is another one that's been under pressure, having been one of our stars of the portfolio. And obviously Freeport-McMoRan was is a really unfortunate operational issue. Two more things I'd highlight on these portfolios is you can look at the major losses in the income portfolio, and that speaks to the type of positions that portfolio holds. So lower beta positions, lower risk positions. So generally less upside, but less downside. We've had probably more upside in that portfolio in recent times than we would have expected, which is nice, but it's all about the downside capture. We don't want to be capturing we want to be capturing a lot less downside than the market. And then the core ETF portfolio goes again around having this is more of the, I guess, not boring, but it is a lower beta portfolio, really well diversified. So you're not going to have the swings and roundabouts as much in that portfolio as you do with the other direct equity portfolios.
No, exactly. I think I'll just reiterate, because everybody knows the stock, James. CBA, it's on there in the active income. When we talk about the elastic band going further than people think, it's a phrase we use quite often in reports. When we talk about how stocks move and how they tend to be going further than people expect, and how they're coming back further than people think, the evaluation elastic band is stretching. CBA, nobody thought CBA would rally by, what did it go? It went up by 30% from its low this year. I caught a huge number of analysts off guard. And that's what we're seeing. We're seeing a lot of these follow-throughs. We saw it last night when momentum traders get carried away. They all get positioned the same way. A lot of people wouldn't realize this, but at one stage last night, in less than an hour, gold fell $90. A bit like Bitcoin last week. So we are seeing a lot of movements, but on the stock level, which is more important, we are seeing stocks follow through further up and further down. So as James said, we will be more inclined to let things run further, cut things quicker. It's probably a trend going forward that's going to stay.
We've just highlighting on CBA. We don't own CBA anymore, so that was sold out of that portfolio early on in the quarter at high levels. So I'm going to say above 180 bucks, but don't quote me on that one. And we actually moved from CBA took a 6% weighting in CBA into a 3% weighting or 2.5% weighting in Helia, and a 3% weighting in Dicker Data. So two very different businesses, but both of those have done particularly well and a lot better than CBA over that time frame. So that was an uncomfortable trade that we suggested, and a lot of there was a fair amount of pushback from subscribers around that. But you got to remain open-minded in the market, and I think that's what whatever your strategy is, investing or whatever your objectives are around investing, it's having an open mind, which is a really important thing, but then repeating a process on a daily basis around how you select equities, how you add them to portfolios, how you construct the portfolios, and being really disciplined around that. And I think that's one of the things that has been really true from our international equities portfolio. So just to give you some context, we launched the international equities portfolio as a published portfolio on the Market Matters website in 2019. There's some performance on the screen there. So it's done over 20% per annum since that time, which is about 6% a year above its benchmark. In more recent times, pretty much aligned with its benchmark over the last 12 months. It's had a really good 6 months, as you can see on the chart there, with a 16% outperformance relative to its benchmark. But overall, when you think about a portfolio, you want to it's the longer time frames that really matter, and we're really proud of the outperformance that this portfolio has delivered. We've had so many requests to have this open for investment, and this has actually been a fairly long process to get this portfolio open for investment. So one of the things at Market Matters is we're about adding value and doing things well, and providing our members with solutions to problems. So one of the problems a lot of investors have is, how do I go out there and invest directly into international shares in a really cost-effective, transparent way that can involve where the administration is taken care of. It's simple, it's cost-effective in terms of the brokerage rates and currency transactions. And we think we've got a really interesting proposition now to our members around the international equities portfolio. So we're really pleased to launch the Market Matters International Equities portfolio, which is now open for investment. You can jump on the Market Matters website and get all of the information around that. It'll hold 20 mostly large cap US and UK stocks. It's primarily US. That doesn't mean that we're not investing within Asia. There's a lot of US listed stocks that are Asian based that list in the US. We like the regulatory environment over in the US. We like having exposure to one currency, and we like the simplicity from an administrative standpoint that it also delivers. Actively managed. So as I said, the track record's a strong one. We haven't just launched this on a whim. We've been going at this for 6 years. We've now got the capability and the technology platform to be able to roll this out to retail investors through it's called a professionally managed account solution. You will see if you invest in this portfolio, it's got $100,000 Aussie minimum. If you invest in this portfolio, you'll get all administration, which is provided through Class. There's a platform access, which is a white labeled version of the InvestSmart platform. Brokerage is charged at 5 basis points. So to give you an idea, say this portfolio has 50% turnover in the course of a year, and you've got $500,000 in it. That'll cost you $250 in brokerage, in addition to the management fee, which is 99 basis points or 0.99% per annum, including GST, and that includes the investment management, administration, and the like. So not sure if you've got anything more to add in terms of that, Shawn.
No, I just think I'd like to reiterate the simplicity of it. It's a really, really simple solution. I do have to apologize to a few members. We hoped it would be ready sooner, and I've spoken to a lot of people about this over the last 6 months, but we're really, really proud of the solution. It's a very simple, very cost-effective solution, which I think is going to suit a lot of investors with Market Matters.
Yeah, and just to give you an idea, like I came on a webinar probably 12 months ago saying this was due for imminent launch. We've had to work closely with other technology providers to be able to launch this. I've been invested in this portfolio through the provider that we're using over the course of the last 9 months. So now we've got the comfort and runs on the board to open it up to a wider audience. So I think it's really important not to rush things, and when we do things, get them right. That's what that's what we try to do at Market Matters. You don't always get that doesn't always hold true. But in terms of the investment portfolio and having really strong confidence in the ability of the technology partner, the security of assets, and how they're reported on is a really critical thing, particularly from when we're going into a new area, investing internationally on a direct basis. So if you think about a managed fund, you're going into a unit trust, investing in more of a black box, if you like. If you invest in the Market Matters International Equities portfolio, you're going to be holding equities directly. So you'll see exactly the names, the number of shares that you own in each underlying equity. You can see the performance and their contribution to their portfolio. You'll know how they're performing from the reporting functionality on the site, and you'll be able to generate a bunch of reports throughout the year, and then you'll get packaged up tax reports at the end of the year, which will lay out all out there for your accountant. So just reiterating on the performance side, so it has been going since 2019, and the performance numbers have been strong. I've operated this portfolio since before 2019 for wholesale investors. So we've had money in this strategy for well over 5 years now. And I can attest to the, I guess, the performance that has been achieved over that time frame. The other portfolio, Shawn, that we're launching today is the core ETF portfolio, not as zingy as the international equities portfolio, but it is an important sort of evolution around Market Matters. ETFs have obviously become very popular, but we've designed this portfolio to be a core holding. So a core diversified framework for a portfolio. So an investor may like to have park a portion of their money in the core ETF portfolio, and then have a satellite approach where they're adding other Market Matters portfolios to their overall portfolio mix, or adding in individual stocks on their own or on their own views. So same sort of structure as the published portfolio. 10 ASX listed ETFs spread across asset classes. We upweight and downweight them. It has full reporting. Brokerage on the Australian side is charged at 4 basis points plus GST, and the management fee is 66 basis points inclusive of GST. Importantly, all of the ASX portfolios are HIN based, so all of the investments sit on an underlying HIN, which adds a level of security. And there's the performance of the portfolio. This is a relatively new portfolio. It was only put into place just a bit over 2 years ago, but the performance has been strong since inception, and it's importantly done what it said it should on the tin. So that is the core ETF portfolio, but that is part of the wider portfolios that are available for investment at Market Matters. So these are all through professionally managed accounts. So you can now on the one platform have access to all portfolios, the active growth, the income, the international equities, the emerging companies, and the core ETF. They're all available on the platform, and it allows investors to upweight and downweight, switch allocations between individual portfolios. Not listed there is also listed there at the bottom is a cash model as well. So that allows investors to easily make a decision around cash. So if you, for some reason, are quite nervous on the market, then you can make the active decision yourselves to increase cash. You can sit in a cash portfolio and then reallocate back in the portfolio as you see fit. So it's a seamless process around allocations of the Market Matters strategies, all packaged up on the one platform with easy switchability between the strategies.
No, I think you've really summed it up very, very well. I made a few notes, James, and you've ticked every one of them. So it's a very simple.
Stealing your thunder, mate.
You have done. It's a very simple, clean setup. We've had a few people open the account already this week with InvestSmart. And as James said, people can upweight, downweight between the respective portfolios. You're not just opening one portfolio, you're giving yourself the opportunity to move elsewhere or to spread the money around if you so wish. And as James said, it's HIN based. So the HINs, your HIN with that's held with InvestSmart or FinClear, I should say, it's a really, really good solution.
Yeah, so trades are through FinClear, and if you want to get more information about this, you can jump on the Market Matters website. There's a click invest button on there, which will detail. You can go through the new investor side, and that'll give you details of each portfolio. All portfolios are based on the published portfolios from Market Matters, so you can go on and see the performance history of those portfolios. You can see the positions that are held in those portfolios. And those positions, by and large, will be replicated on the investable portfolios that are now open. We promised you 8 stocks that we like here because we know everyone likes a stock pick out there. So we've already spoken about Goodman. Go through the rest, Shawn.
Well, Xero is a stock we've held for a long time. I've kind of already touched on it. It's in that group. It's in
We've
the.
only bought back into it, Shawn, post cap raising.
We did what would be, and we went a bit early, James. In hindsight, we did go a bit early. We've gone a bit early. I have talked about it a few times. If it comes back a bit further, it would certainly be one of those stocks that we'd be topping up. We're not looking at getting out. It looks really, really good. The growth that Xero's in position for moving forward, especially overseas in the US. It's also going to be a big beneficiary of AI. We keep saying that, people keep talking about it, but it's very well structured in that regard. We use Xero at Market Matters. I think it's a great platform, and once people get on Xero, it's very sticky. It's a bit like WiseTech, another stock, the logistics stock. Once you start using it, it's awfully hard to get off, isn't that right?
Yeah, the acquisition of Melio over in the US obviously caught some people by surprise. We thought they paid a bit too much for it. We'd actually sold the stock fortuitously just before they announced that acquisition. So we took a really strong profit on Xero. We waited for the cap raise to work through, and then we have gone and bought back with a smaller weighting in the active growth portfolio, and we very much intend to increase that weighting into the future. Melio is all about payments plus scale, access to payment infrastructure, which Xero really needed, and also scale into the US market in a really quick way. They can't afford to wait around and build the technology and then build scale in the US. They've bought it, and we think that's a really good approach, albeit it creates a bit of indigestion in the stock price in the near term. Great CEO that took over only a couple of years ago, who's really turned the dial on this balance between growth at any cost and then growth in terms of reasonable growth, but also reasonably strong earnings and margins. So we think it's a good balance, and we think the risk reward stacks up here. We've talked about Dalrymple Bay. AGL, interestingly, it's up about 4% today. It got upgraded by a broker this morning. That's in our income portfolio. We really like that. We think the risk reward looks really good at these current levels. It was Barrenjoey this morning, who's the #1 rated analyst on the stock. They just put a $12 price target and upgraded to overweight this morning. It's trading about 9.20 at the moment. PEXA Group, which is changing the way real estate settlements happen. So that is a phenomenal stock. I know it's had a good run in the last couple of months, but we think this is this is a growth story that's taken 4 or 5 years to get to where they are today, and they're now just at that point in monetization, tying back into what we talked about in terms of platform businesses. Monetization, the point of monetization is really important from an investor standpoint. So PEX is one of these stocks that we really like in the medium term. SiteMinder, good run, but we think it goes further. And then some of these, Alibaba in the internet, with exposure to China, it too has run hard, but it is really inexpensive relative to other AI names globally. So that's one we continue to buy. And then Zillow's actually pulled back. It's pulled back circa 15% in recent times. We wrote about this morning. We still like that one. So 8 stocks we like here, because some of the feedback we get is that, gee, the market's run really hot. Portfolio have had really strong moves. There's nothing out there to buy. Well, there's 8 stocks we'd be happy to buy here and now. And then I'll turn it over to questions. Shawn, I've got a couple here that were sent through early on. If you've got questions, please feel free to put them in there. Nick has kicked things off with minimum investment is $100,000. Yes, 100,000 Aussie in the international equities portfolio. All other portfolios have a minimum of $50,000 investment, but obviously the minimum for each portfolio is that minimum. So if you want to, if someone wants to allocate to the active growth portfolio and the international equities portfolio, that's $150,000 minimum. One of the combinations that I actually quite like is this premise that we invest in Australia for income and we invest internationally for growth. And it's sort of one of the mandates that I run our wholesale portfolios on. So the income portfolio with a combination of the international equities portfolio is actually quite a, the performance metrics on that combination, we've run the numbers through our models is really good in terms of the volatility or lack of volatility from a domestic equity side and fixed income side into the growth outlook available on the international equities portfolio. So that'll be something to consider.
One quick question, one quick point, JG, which we often get asked this question. If you do put $100,000, for example, into the international portfolio, and we have a 0.5%, 1% pullback, and so the position is only worth 99,000, you don't have to top up. That's the establishment to start the ball rolling. If it goes below, dips below 100,000, you don't have to top the account up.
Yep. A question on Dicker Data. Is Dicker Data play into the AI thematic? 100%. So Vito, there's going to be as Dicker Data basically sells tech into SMEs. So we use Dicker Data here for all our technology piece. So when SMEs need to refresh technology because AI has created so many more features, they'll be using Dicker Data to do that. That's why we own it in the income portfolio. It's got this combination of reasonable growth, reasonable dividend yield, and it's got a positive thematic coming through from the AI transition. So, or tech refresh cycle underpinned by AI. So yeah, really like Dicker Data, which is DDR. Got a question in terms of the emerging companies portfolio minimum there, $50,000 minimum in the emerging companies portfolio. There is a question about brokerage rates. So as I said, so right across the suite of Market Matters portfolio, so anything domestic focused, which are all HIN based, they're charged at $0.04%. So that's 4.4 basis points inclusive GST. That's a mouthful. So if you're trading a $10,000 position, that'll cost you $4.40. International is 5 basis points on the US, 8 basis points in the UK. There are no minimums on those. So again, if you're trading $10,000 worth of US shares, it'll cost you $5. In terms of another question here on reporting, who does the reporting side? It's all done through Class. So you appreciate Class is a portfolio reporting self-managed super fund administration platform. So Class is the functionality that we're using to underpin the reporting side. And then further to that, the responsible entity that sits over the PMA structure is InvestSmart. So ASX listed InvestSmart. What else have we got here? So do you favour hedged or unhedged, please? So I'm a natural unhedged investor in international equity. So if I think about, tie back into the international portfolio that we spoke of before. So in the last 3 months, that has done 16.9% over that time frame, which is actually inclusive of a 4% detraction from the currency. So the higher Aussie dollars has detracted returns from 4%. So in that environment, when the Aussie dollar is going up, then yeah, hedged. The reason I say I'm a natural unhedged investor in international equities is because it works to cushion return. So say markets get really volatile, like, go back to COVID, for instance, when markets around the world dropped really sharply. The Aussie dollar dropped sharply at that time as well, which cushioned our which cushioned the returns that we achieved from our international investment. So if you want more diversification in portfolios, then you would naturally go unhedged, because the currency can provide a natural diversifier as well. But each to their own. I mean, will the Aussie rally 5%? It could well do, and it could well detract from returns. But as long as you're picking the right stocks and performance is going well, then I'd rather have the benefit of the currency deviations when things turn more volatile. If things don't work out in Australia as we expect they will, then the currency will go down, and that will provide you a natural offset with your international equities. Anything more there, Shawn?
No, I think at the end of the day, James, we're trying to add value with stocks. We're not FX traders.
Yeah, and it's really important that we're talking about how we're managing portfolios, etc. The advice provided today, across all Market Matters publications, is generally in nature. So each individual member investor should consider whether it's relevant for their own circumstances. And then in terms of Nick's asked about HMC, you're going to hold it, top it up. This has been a really poor performer in the emerging companies portfolio. We're holding it, not topping it up at this stage, but that will be our likely next move. So there is they've lost confidence. HMC, the market has lost confidence in them. It's a fund manager that relies on raising money to grow. So when you can't raise money because your performance has been poor, then you're not going to grow. So they're actually very shrewd operators, HMC. So I would be really reluctant to cut the position now, because I think they're working diligently in the background to try and restore shareholder value. So it'd be a hold for now, but not a top up. If you invest 100,000 in international and 50 in income, and you promote ease of switching, I assume you can't pull funds out of international and go below limit. Yeah, that's correct, Gary. It's not $100,000 on the platform spread across all those portfolios. 100,000 minimum in the international portfolio needs to be retained. You can actually make a decision. So you can either go, if you want to go below 100, you'd have to sell down the whole portfolio, and you could move that to cash or another portfolio. But it would need to be, you couldn't reduce it less than $100,000. The reason we have that minimum in place is, if you think about some of the US stocks that we've got in portfolios. So these are high valued shares, so that the shares have got worth multiple hundreds of dollars per share. We need to have minimums in place that make it meaningful for investors to hold each individual share within the portfolio. So we think $100,000 strikes the right balance of making it accessible to people, but not being too much that it scares people off in terms of making that initial allocation into the portfolio. Do you need to, Matilda's asking, do you need to register and get sign-in password on your platform to look at performance of each portfolio? Yes, you need to. You can jump on if you're not a member of Market Matters, you can jump on and become a trial member, and then you can see the performance of all the portfolios on the Market Matters website. We update that monthly. September performance got updated this morning, so those portfolios are all up to date there. What does the annual tax paperwork come out, please? So it's actually just going out when you have it'll be September, back end of September, early October. So if you hold REITs, for instance, they obviously have pay distributions at the back end of June. So it takes a while for the platforms to obviously reconcile those payments once they land into accounts. So expect annual tax paperwork to come out in back end of September, in the first week or two of October at the latest. And DRPs in your international portfolios is a question. That's a really interesting one. I don't know off the top of my head if we can do DRPs into the national equities portfolio. I'll check that out for you, Paul. Are you across that, Shawn?
I'm not actually, James. That's the first, which is
Yeah,
good.
I haven't.
I like to learn.
Yeah, I don't think you can. To be my inclination is to say um, no, but I will check, Paul. All right. Well, as we've gone over time, so it's 1:25. We've gone nearly an hour now, so we'll wrap it up there. Thanks to so many of you on the line today. We've covered off obviously performance for the first 3 months of FY26. It's been strong across the suite of Market Matters portfolios, which is pleasing. But obviously, we don't lie on our laurels. We continue to try and outperform the market year in, year out, and we won't do that every year. That's to be that's to be sure. But over time, that's the important path that we're progressing on. So, if you'd like more information about the international equities portfolio, the core ETF portfolio, or all the portfolios that are now available on the one platform, just jump onto the Market Matters website, or you can call the numbers that I had on the screen just before, 1300 301 868, or drop us an email if you'd like to do it via email, info@marketmatters.com.au. One of the team will get back to you. There's some lovely friendly voices that you can chat to about the portfolios, how you go about investing in them, and any questions you might have to get comfortable with them. So again, thanks for joining us. Thanks for your ongoing support of Market Matters, and we'll have another webinar to you next month. Shawn, thanks, mate.
Thanks, guys. It's been a pleasure.